If you have a large portion of your retirement portfolio invested in the US equity market, you probably want to know what to expect from it over the long term. Current 10-year total return estimates from some of the most respected analysts range from -1% all the way up to 7%. Clearly a very significant range of opinions. I'm going to show you an approach based on a few simple concepts that has been reliable for the past 80 years and will show you the likely path of the S&P 500 over the next 16 years. If you are concerned about the sufficiency of your retirement portfolio, this should really help in your planning. Okay, so in reality, stocks are like bonds in that your long-term return is reasonably predictable. Only the trajectory to get there is uncertain. And here's why. If you purchase a bond and plan to hold it to maturity, then your return is 100% predictable at the time of purchase, assuming no default, of course. Because at that point, we know what the coupon payments are, we know what the terminal payment is, and we know the purchase price. So we can calculate precisely the yield to maturity. Now, this does not mean that the bond price won't fluctuate in the time that you own it, but if you are planning to hold it to maturity, then your yield to that point is certain. Now, it turns out that stocks are actually very similar to bonds in the sense that if you plan to hold it for a very long time, being 10 years plus, then your long-term return is reasonably predictable based upon the earnings yield at the time of purchase. But first we need to clarify how we determine the earnings yield. Earnings, unlike bond coupon payments, are not stable throughout the economic cycle. They tend to vary depending on where we are in the cycle, primarily due to changes in GDP growth rates and profit margins. In order to adjust for this, we use a process developed by Professor Robert Shiller from Yale, and he uses the inflation-adjusted average of the earnings for the S&P 500 for the past 10 years as a normalized representative run rate for earnings. We actually find a 16-year time frame to be the most accurate. So adjust each of the past 16 years' earnings into today's dollars and then take the average. Divide this average by today's price to get the cyclically adjusted earnings yield. If you look at the slide and compare the cyclically adjusted earnings yield, being the blue line, with the subsequent compound annual return over the next 16 years, being the green line, you will see that the lines track very closely. The cyclically adjusted earnings yield that you purchase it at today is very predictive of your returns for the next 16 years, and this relationship has held true for the past 80 years. Now, this methodology does not include dividends, so you can add the expected dividend yield to get your expected total return. As at mid-2016, we have a cyclically adjusted earnings yield of around 3.5%, so that is what you can expect to earn over the next 16 years, plus about 2% for dividends, for around a 5.5% total return for equities going forward for the next 16 years. The historical average has been about 11%, so today's outlook is significantly lower than that. So the price you pay today is predictive of your long-term return for both stocks and bonds, and the market, it turns out, is pretty efficient at pricing itself for the long term. Now, this is very interesting because based on the information we learned in the last slide, if we are able to predict compound returns going forward 16 years, we can actually generate a plot of the S&P 500 going forward 16 years. So the plot point, for example, at 2017 would be based upon the cyclically adjusted earnings yield from 2001, 16 years ago, and basically we take this out going forward to 2032, and you can see where the S&P is likely headed. The estimates and the actual turn out to be very close, as in the previous slide. It's the same information, just presented from the index perspective. And so the green line shows what the path forward looks like, and it doesn't look too bad, but it's actually well below historical norms. Now, the peaks and troughs that you see are actually a function of previous peaks and troughs, and it will not follow this exact trajectory, but it provides a reasonable expectation for the long term and has been fairly consistent based on 80 years of historical data. Lastly, this chart shows a segment of the previous graph just going back to 1995, and we just want to point out that while the end point is reasonably predictable, the trajectory to get there is not. And so it could be something like the green line, or it could end up being something like the red line, which is more volatile. If you are planning on holding it for the entire 16 years, though, it makes no difference in the same manner as the bond purchase described initially, where your yield to maturity is certain, provided you actually hold it to maturity. So in closing, from a planning perspective, you can get a pretty good sense of what to expect from your US equity allocation over the long term, provided you are comfortable with the expected return and have the discipline to hold on to it through the ups and downs.